I hear so many people saying, give me the argument. They'll say, well, shouldn't I just have savings? Then there's no, money coming out for the death benefit. I don't care about the death benefit. I just keep it in savings and I invest it. I'll make more money now. So why should I do that versus using whole life? What's your answer to that?
This podcast is for informational purposes only and does not constitute financial, legal, or investment advice. Please consult a professional advisor before making decisions based on what you hear on this show.
What's up, tribe? Today we're going to be doing a crossover episode with Chris Miles from the Money Ripple Show. You may have heard of him before. He is another expert in the infinite banking space. It's something we haven't done in a long time, which is bring another infinite banking practitioner into the room. And me and Joey and Chris sit down and just really talk candidly about what we're doing personally with the IBC, how it's impacted our lives, where it all originated from, and then what's next. Hope you'll enjoy this episode. Let's jump in right now. All right, guys, we're going to sit here and have a conversation around, I think, infinite banking, passive income, probably a little bit about what's right about the world and what needs to be fixed from our own angles. And I'm excited, Chris, to share you with our audience. And if you guys have not followed Chris, his show is called Money Ripples. And I think a great maybe exposure, if you don't mind, just share your background a little bit, kind of how you started in this, so that way people will understand why listening to you maybe is important.
Yeah, I started out like some people do, especially in this space where I was a traditional mainstream financial advisor, AKA salesman in a suit. And so I started doing that just right after 9/11. So during Y2K, great time to become a financial advisor when the market's tanking. So I had that baptism by fire. And I was the traditional like mutual fund guy. Even did some insurance stuff, nothing with whole life, by the way. I actually poo-pooed all over whole life all the time. So I was the person that hated on it. And I just drank the Kool-Aid, right? The whole reason I actually got in, funny enough, wasn't because I was planning to go into finance. It was actually because I was planning to become a business consultant. But I figured if I'm going to become a business consultant, I should have real life business experience. So I was just trying to find some business to start, just do for a year, go back and finish my MBA, and I'll have some more tools under my belt, rather than just having a degree. But as I started looking around for businesses, the first one that seemed interesting was being a financial advisor because I wanted to learn about money. I wanted to learn how money worked and investing and things like that. And worst case, I figured I'd learn something for myself, and even better, maybe I'll help my dad. Because understand, my dad was like the penny pinching saver. He was Dave Ramsey before Dave Ramsey existed, right? This is the guy he bought everything on sale, case lot sales. I would eat Cap'n Crunch for entire years straight, just because he bought a whole box crate full of it. I still have scars on the roof of my mouth from sucking on those stupid Cap'n Crunch bits.
Oh, if you didn't scar your roof of your mouth with Captain Crunch as a kid, you didn't live, man.
You didn't live, right? It's like playing on the streets or on the freeway, like your parents always asked you to do.
If you've listened to our show for any length of time, you've heard us talk about infinite banking and how we were able to use that concept to create over $50,000 a month in passive income. But it's just not that easy to figure out, how does this all connect into my own personal system?
Stallion, that's why we created the passive income operating system, bro. It shows you how to turn active income into passive income. It makes all the steps come together. If you would like to get access to it as a podcast listener, we've never given this away in public before, go to what'swhatwallstreet.com/PIOS.
So my dad was the penny pinching saver. He was like the ultimate version of cheap, and that's all he taught me was save, save, save. But on the same note, he would also tell me, Chris, I'm going to work until I'm dead. This job is literally going to kill me, because he had already had strokes and heart attacks by his 40s and 50s. And so I thought, worst case scenario, if I become a financial advisor, maybe I'll learn something about money to give him a few years of his life back so he won't just die working. Well, 4 years into that world, right? And I drank the Kool-Aid. I told you to set it, forget it, save everything, stuff away forever. And hopefully someday you'll have something, just save for 40 years and you'll be a multi-millionaire, right? Because you make 12% in the market and all that kind of crap. Well, anyways, as after 4 years, my dad said, well, when are you going to sit down with me? So I sat down with him, looked at all his finances. The guy was 100% debt-free, including his mortgage. He paid off in 18 years. So he paid off his house early, debt-free, stuffed money in his 401k. And then as I sit down, I said, Dad, you're 61 years old. If you want to retire today, you're going to have to die in about 5 or 6 years, because that's when you're going to run out of money. Okay, Chris, that's not what I wanted to hear. What do I do? And I said, I don't know. You did everything right from what I teach as a financial advisor. And so after that, I was pretty upset because the very person that kind of inspired me to become a financial advisor, now I realized I was selling a pipe dream, right? I was selling hopium, right? We're smoking it together and stuff, and it wasn't working. And it was just a month later, I talked with a friend of mine who I hired to be a financial advisor on my team, but then he quit to go do real estate investing. So as we're chit-chatting and stuff, he says, well, man, my life is awesome right now, Chris. Like my dad and I have partnered on some real estate deals, and we've now doubled his income as a professor at the local university. I said, wait a minute, you've only been doing this like 5 months. That's too good to be true. My financial advisor brain can't handle this. He said, well, I'm doing it. And then he asked me these 2 powerful questions. He said, Chris, how many of your clients are truly financially free where they don't worry about money? I said, well, I got some retired doctors and stuff that I inherited from other financial advisors giving them bad advice. So I would say none. There's none of these guys are free. Like they're all worried about outliving their money, right? He says, okay, I didn't expect you to be honest, but that sounds awesome. How about this? How many of you guys as financial advisors are financially free, not off the commissions you're earning, but actually doing these mutual fund investments? And I said, well, there's guys working in our office since the 1970s, so I'd have to say none. He's like, well, there's your problem. And I said, well, give me the answer. He's like, I won't give you the answer because you just got done arguing with me that stocks are better than real estate. I said, listen, I'm open. Give me something. He said, all right, if you really are, and I don't think you are, go find this Robert Kiyosaki book called Who Took My Money? So a lesser known rich dad book, right? Just sum it up for you. Mutual funds suck is the whole premise of Who Took My Money. So I read that. I got the gist. By the way, I was stock trading, so I was starting to already question mutual funds anyways. And then, of course, he said, now go listen to this AM Talk radio show with these 2 real estate investors. And I did. And after a few months, I had to make a choice. I said, okay, I can see that all the things I'm teaching about, set and forget it. You're in for the long haul, especially if the market goes down. Then you're in even longer, right? And, high risk creates high returns. Well, when does a 90% chance of losing create a high 90% chance of winning? And, all these kind of things that just didn't make sense. I realized I'm teaching all this stuff. And so I quit. I vowed never to teach about money again. I said, I'll just be a mortgage broker and I'll do stock trading on the side and teach ballroom dancing as well, And so I was doing that in 2006, but I also wanted to learn what these guys knew about real estate. And so I started doing stuff with real estate investing, like with rentals, realized I could lend my money out and do hard money lending and things like that, which I never heard of as a financial advisor. And later that next year, and later in 2006, I was actually able to retire when I was 28 years old. I had enough passive income coming in to cover my expenses. And naturally, what normally happens, 1, I love teaching, but 2, is just the fact that, everybody kept asking me, okay, how are you 28 and retired? Eventually I came out of retirement in 2007, worked with a guy you might know. We created a company together, a guy named Garrett Gunderson. We ended up creating a company together and doing some stuff that way, and was with him for several years, went broke during the recession, went over $1 million in debt, had to dig back out of that hole. And then I came back and became financially independent the second time in 2016. So I had to dig out of a big debt hole and do it again. So I actually had to do it twice. So when people's like, how'd you retire twice by 39? Easy. I screwed up the first time. The best plan is doing it right and do it only once, right? Like twice is not something to brag about. That's just something that was kind of what happened. So that's the thing is, like, for me, I realized that, with real estate and everything else and passive income, that was the key. Then I also learned in that time, 2006 and on, about infinite banking and things like that, and how that can work in tandem with what we talk about with like passive income and investments and things like that, where like you guys talk about creating wealth without Wall Street. And that's literally what I've done twice. Like I literally got out of the stock market by 2007, 2008, never looked back and don't regret it once.
I love that. Stallion, I know for those who are listening to the Money Ripples podcast, they don't know your background. Give the 2-cent version that would be important and maybe they could connect to.
Well, I was similarly in the mortgage industry for 11 years whenever I first got a hold of Nelson Nash's book, Become Your Own Banker. And that was 4 years before I left the mortgage industry, when I finally realized, I was like, wait a minute, all the stuff I had been doing, making a lot of money in the mortgage business actively, but I was tied to my phone. I was literally, and Russ busts on me all the time, I had it in a holster on my belt. I mean, I was...
He did, man.
I remember guys like you.
It was sad. It was like, bro, this is a bad fashion statement.
But you're living
off of referrals, and referrals they own you in a sense, because if you don't answer, it's you get the first call, but it doesn't mean that you're not a commodity to a certain extent to where they're going to be like, well, if you can't, help me with it, then somebody else will, kind of thing. And so you just have this constant fear, like, I need to be available. I need to be taking this next phone call from this next referral source, which means you're in complete jail, right? You're on vacation, but you're not actually there. Physically, you're there, but mentally. And I have 5 daughters, and I found myself multiple times on vacation and telling my kids, my wife, hey, you guys go on down to the beach. I'll be there in, just right after this one phone call. And then 4 hours later, they're coming back up to the condo. I'm walking out, and they're just disappointed because there's dad, but he's not really there. And I did all the right things, Chris. I was putting money in my 401k. I was doing the IRA situation. I was starting to get into 529 plans, losing all access and control of my money and thinking I was really doing well. But I never felt financially free. I never felt financially successful because of what we now know is passive income has to exceed monthly expenses to be truly free.
Yeah.
And when I finally read that book, it showed me that there was a different path. I didn't know what to invest in yet, but I knew that I needed a different place for my money to reside. And infinite banking gave me that. Fast forward 4 years later, I've started multiple policies on myself, on my wife. And then I'm sitting there at a conference with Russ, and I'm like, man, why do more people not know about this? Like, I felt like the kid holding gold in his pocket and nobody else had. Like, I was like, I need to start giving this out. Like, there's people that need to know this. And I don't know, from a faith perspective, I was sitting there and I almost audibly heard the Lord say, you need to be telling people about this. And I was sitting there making over $300,000 in the mortgage business at the time in my late 20s. And my wife didn't work. And we had 4 daughters, or about to have 4 daughters at the time. We have 5 now. And I was like, that's a big risk. That's a big, leap lifestyle wise to go from that sort of income to zero overnight. But that was really a confirmation, and started in 2014 with Russ. And then we started Wealth Without Wall Street in 2016. And the podcast came in 2017. And that's just completely blown our minds on what all there is to invest in outside of Wall Street. Because here we are, we're sitting here with all these policies with money just, stuffed into them. And our clients are saying, what do we invest in?
Mm-hmm.
And we're like, I don't know. Maybe buy a piece of real estate. I don't know. And then the podcast taught us there's all these different places you can do it. And, fast forward now, we create over $50,000 a month in passive income just because we became investors in the process, and just from learning from other people. So that's my quick story.
I love it. Russ, I'd love to hear yours too.
Man, well, I felt like mine was your story. Like you and I are like brothers from another mother, man. The only difference is my dad was the opposite of Dave Ramsey, never saved a dollar. If I would have sat down with him, I would have been like, never stop working. Unless you get some, more disability checks from the government or whatever, because this is not going to work out. You haven't saved anything. You have nothing. I didn't know what money was, so I became a financial advisor as well. I thought, if I don't really know anything about money, I should become a certified financial planner. That'll really teach me what not to do, basically. But at the time, I thought I knew, and then the market crashed in 2008 and realized that nobody around me, all my mentors at the time, were just as lost and just as unknowing about what happened in the market and why, it wouldn't happen again. Nobody knew, everybody's looking at their mutual fund wholesaler or whatever, for the next money pitch that you're going to go tell people, oh, if we would have just done this, right? Like we would have used, more of a tactical allocations. We would have, we would have soared through this, but nobody did that, right? Like, I mean, everybody's experts after the fact, right? They can always look backwards and say, oh, but that was to me the eye-opening experience of saying, if I don't understand how people make money, then, how can I really be teaching people and taking their money and babysitting it for them when, there's some of those people that I think their babies die under my watch, basically. And that just led me down a path of just trying to learn. That's where I ran into Nelson Nash at an event in Orlando, Florida, and heard this concept of becoming your own banker. Be honest, at first I thought it was the stupidest idea because it talks about whole life insurance, as and as an investment advisor, that was the opposite of what I envisioned myself doing. When you watch the Wall Street movies, of how you're going to be successful and driving fancy cars and, wearing fancy suits. It wasn't selling whole life insurance. That was the fat guy that was like bowling on Friday night and, wearing his phone on his hip, kind of like Joey was, kind of thing. So I thought that was not very attractive. But what I did learn is that the people who had access to money were the people who had the most success. And I didn't have access to money. Everything I had was tied up in the markets. And I thought, well, okay, well, I should change that. And, I was equally as dumb by putting money in cash value because I still didn't know what to do with it. Right? Like I didn't know what to do with it when I was invested in the markets. I didn't know what to do with it when I was putting it into life insurance. So from 2009 to, 2016, 2017, I didn't know what to do with money. I was just stacking it up. I'd make an investment here or there, but it was usually poorly orchestrated. And, I'd do it. Oh, Chris did this. Oh, okay, I'll do that. That sounds good. I got money. I might as well should invest it, right? Money burning a hole in your pocket, just in cash value. And it wasn't until, like Joey said, when the podcast came and we started interviewing people and they started showing us these different strategies where I realized that investing looked a lot differently to people than what I had been exposed to with, just a couple of single family rental properties or, like maybe somebody buying a, apartment complex or whatever. There were so many different things. And I guess the biggest aha moment for me, Chris, was learning that I had to become a better investor. Like I couldn't just hand over my money to somebody and expect it to just go up in value. Just like I've been teaching. It was ironic because I've been teaching people for the last, 8 or 9 years that you just can't give your money to the Wall Street brokers and expect it to go up, right? Like you have to understand what's going on with it. But yet I was not doing that in the alternative investing space. And once we really started digging into how to become better investors is where I realized that, man, there's things that I should invest in, things I shouldn't. And we've lost obviously lots of money along the way too, right? all those stories of, what not to do now, but it's led us to a point of saying, oh, yes, the path to freedom is not by having millions and millions of dollars in accounts. It's in having cash flows that exceed our monthly expenses. And it's got to be done by us understanding how to do it versus not. I want to throw this out to you guys, and then you guys can chime in. Sorry. I think the topic that I think is interesting for our audience is because both of them heroes talk about the infinite banking concept constantly, right? There's some, things in the marketplace that we see and hear that I would be interested, Chris, especially from your opinion of what gives you the eeks, they're like, man, like, I don't like that I wish I wasn't seeing other people attach infinite banking in that thing or saying it in that manner, like, because there's definitely goods and bads and all things that are out there. But what are some of those things that make you kind of cringe when you see it?
Oh my goodness. I know you beat me to the question. I had other questions for you too, but no, let's just go there. Cause the thing that gives me icks, I mean, my first experience buying a whole life policy was from somebody who gave me the Nelson Nash book, told me to read it, And, that's where I started to drink that Kool-Aid, and the only reason I did is because all these real estate investors just said it was the best thing since sliced bread. But it was sold to me very much as like, you're going to build this up over the long haul, and then eventually you're going to buy a car with it. Right. And that was one of the biggest ones I knew was a mistake. I mean, that was number one was, the reason I had to say that, why you had to spend so many years, because it was so expensive. Like it was all base premium, no paid up additions, right? Like you're buying straight whole life. And I remember Garrett actually went on the radio to debate a real estate investor on the topic, and they advertised it for days. It's gonna be like the showdown. And Garrett got his butt handed to him. It was horrible. And I was cheering for Garrett. And then I was like, that was nothing. It was all the thing I see with infinite banking is there's a lot of platitudes, but there's not like anything that says, hey, this is how you're actually going to get ahead as an investor, right? It was never from an investor perspective. It was always from the insurance agent perspective. And so I was sold that, you just buy it. It's expensive up front. That's why I lost my policy in 2008, because I paid like $25,000 in premiums, zero cash value. So when I hear people out there saying like, oh, that's the best way to go, you should have max death benefit. That's another one I hear from some of the older school infinite bankers, right? Max death benefit, always go that way. It's very guardian based, guardian company based. That one was what I was sold, and I lost my policy. By the way, I asked him up front, the agent that set it up for me, I said, listen, can we pull some different levers where I can get more cash value into this? Because I knew in my previous financial advisor days, I could set up like VULs, right? Very universal life, index universal life. That's another one we should go on too. But like I knew you could pull different levers to get higher cash value, right? I would get paid less commissions if I did that, if I get higher. And the agent told me with whole life, he's like, no, you can't do that. You'll turn it into a mech. It'll get taxable. So I said, okay, I'll take your word for it. Then I found out later that he lied, right? And I confronted him about it. And he finally just said, Chris, I just designed it that way because I couldn't afford to cut my commissions. And that scarcity mindset I see happen so prevalent. I know there's some people that say, here's the kind of split you should see in a policy. And they have their different numbers they throw out there. I won't mention names, of course, because they're probably mutual friends of ours. But they say that, and I'm like, there's nothing that shows that that's true, right? That particular percentage split is any better for the client, short-term and or long-term, right? So that's one. Two, like I mentioned, like you buy cars and houses with it. I've realized after I got into it, they always tell you to pay, and you pay yourself back with interest, right? You just pay yourself back interest. I'm like, oh, like a 401k where literally there's interest you're paying back to yourself. That's not the case with whole life policies or infinite banking strategy, right? It's no, you're paying a principal interest payment, but you're still paying interest to the insurance company. So why, if I just got offered, this is literally a year and a half ago, I got offered a 3.99% car loan offer. Why would I take a 5 or 6% loan on my infinite banking policy other than not having a required monthly payment? That's maybe one argument. But other than that, I'm like, no, I'm going to leverage the bank all day long for money that's relatively cheap, that is not my own money. And then money that the banks won't give me, I'll go use my policy for that. Whether it's a down payment on a property, whether I'm investing in something where obviously I can't get bank money to borrow to go into investment, I'll use my policy for that kind of thing, or just, keep it in cash, right? So those are the things that kind of drive me nuts that I see from a lot of the, YouTube or influencers that we see today. Obviously IULs, people saying that you can use IUL for infinite banking. We all know that Nelson Nash never intended that to be the case. So just that kind of stuff, that just drives me nuts. I know what are some things that you guys would add to that?
Well, I'm going to jump in there on the IUL, VUL train, because like you, very similar background. That was where I started. If I did any insurance early on, it was a variable universal life, because we're using the stock market. That was the best way to build wealth. And you're using the wrapper of the insurance company to help you build it tax-free, right? Tax deferred, all of those things. And the thing that nobody tells you about is that when the market goes down, you have this double whammy, right? Because you're paying insurance on the difference between the death benefit and the account value. And every year, the insurance gets more expensive because you're 1 year older, right? So you're buying, 1 year basically renewal term insurance. And if you have $1 million death benefit, for instance, and you had 100,000 of cash value, and the market goes down 30%, well, now you're buying death benefit not from 900,000, the difference between $1 million and 100,000. You're buying the difference between now 70,000 and $1 million. So your expense has gone up because you're buying more insurance, but also now you're a year older. And so you have this double whammy effect. And I saw these variable universal life accounts double, like just going down to where people had to go and put more money in them just to keep them alive. And then I acquired, some people who, I don't know how you said it earlier. You said from financial advisors who had failed or whatever, you adopted them. I had a couple of those, and I had some people in their 80s that had bought variable universal life policies, 15 years prior. And these insurance policies are about to lapse. And they're like, the husband was literally on his deathbed, and she's trying to figure out how she's going to make this premium that if she doesn't make the policy lapse and all the money that she's ever put in there is gone. And more importantly, the death benefit, right, that she was kind of banking on was going to be gone. And it was really, really scary for them to try to figure out how they were going to pay those premiums. And then IUL is, people love to show the illustrations, right? Like it's just like going and pretending that the guy showing you his investment deck is going to work out exactly the way they're showing it, right? Like, insurance is not meant to be bought for, the best case assumptions. It's meant to be bought when you're in the worst case scenarios. And I think the IUL was one of those that was like, oh, well, it can't lose money. And that's a false-ism too, right? Like they have floors that says the account can only earn X amount. But again, if the underlying index doesn't earn anything that year, the 4 to 5% expense charges with internally can actually make the account go down. And when that goes down, the same exact thing I was talking about with variable universal life kicks in. You're a year older, you're paying insurance on the difference between the account value and the death benefit. And so now it has this double effect. So any years where we had down years, those things really have trouble. And what I came to love about whole life is that it gets better every year as we get older, right? Because to be honest, we're all have a high capacity right now where we are in life and understand all the things we're doing. But when we get older, I was at a funeral yesterday of someone who's in their mid 80s. My guess is they probably wasn't operating at the highest capacity of understanding how to handle their, life insurance policies at that point. And they don't need to be worried about, oh, are my expenses getting more, getting higher, and then is this thing getting ready to lapse?
Yeah.
Right.
And I would just add the thing that kills me is the idea that you can get rich by financing expenses.
Yeah.
Right. Like buy all your cars and that's going to make you make all this money. It's going to be the best.
Pay all your bills.
Pay all your bills through it. And, that's how infinite banking makes you rich. There is no substitute for becoming an investor. Like we've already said it, you can't abdicate it to a financial advisor, even though that's what Wall Street wants you to believe. And there is no substitute of, oh, I know how to buy cars, so I'm just going to use this new system to magically make money off of buying an expense. You have to actually invest. You actually have to take cash value in this case, borrow against it, go out and buy an asset that produces passive income. Until that happens, you're no better off. I don't care what system you're using. And so when people peddle that idea, or a similar idea is, well, if you just buy a policy and then you borrow against that policy to start a new policy, you just keep laddering these policies, magically you're going to have more money at some point. There's still an input of a premium, and you still have to take that cash value to buy a productive asset. Borrowing against one to borrow the next one. There are times for that when you're preparing for a windfall. Okay, so don't hear me like poo-poo the idea completely, but the 99% of people that are being told to ladder policies like it's going to be a magic pill for them, bad idea. It is going to explode, and they're going to be like, wait a minute, I thought this was supposed to make me rich. And anyway, so those are my top two for sure.
Yeah, those are all great ones.
There was nothing worse than walking into class when you're in school and the teacher saying, "Pop quiz day." Why? Because you were unprepared. Are you unprepared, though, for financial freedom?
Don't be. Find out how close you are by taking our 30-second quiz at wealthwithoutwallstreet.com/quiz.
Hey, Tribe, have you ever wondered how billionaires actually invest?
Because let's be honest, billionaires aren't following the same playbook as everyone else. They're not chasing that next hot stock or jumping in and out of the market.
No, they're thinking in decades, not quarters. They're focused on cash flow, not just net worth, and they're building legacy with every move that they make.
That's why we're excited to tell you about a podcast that we love. It's called Invest Like a Billionaire.
Yes, hosted by our friends Ben and Bob Frazier. They break down the exact strategies that ultra wealthy use, the family offices, the private equity firms, and institutions.
And they make it simple and actionable for people like us. Whether you're just starting your journey or looking to level up, this show gives you a backstage pass to billionaire-style investing.
All right, so go search Invest Like a Billionaire on your favorite podcast app and hit the subscribe button.
This kind of leads to the question I want to ask the two of you, because you came from that saver mentality, just like I did back in the day, right? But you were even more recent than I am when you started to convert, not just the whole life concept, but even like passive income. What was it that got you to believe that saving in a whole life policy was better than just putting it in cash? Because I hear so many people saying, give me the argument. They'll say, well, shouldn't I just have savings? Then there's no money coming out for the death benefit. I don't care about the death benefit. I just keep it in savings and I invest it. I'll make more money now. So why should I do that versus using whole life? What's your answer to that?
Well, I will say, the thing that got me early on was Nelson Nash talking about human behavior. And I resonated with it so much, right? I saw my dad who would spend every dollar he had, right? And we would go to the pawn shop and pawn his guns or his tools sometimes in order to make his mortgage payment. And I just knew human behavior. And then because that he didn't want to lose those guns were important to him, then he would go to work to make enough money to go back and get them back, right? Human behavior took over. And when Nelson Nash talked about the human behavior inside the Becoming Your Own Banker book, I resonated with that because of my experience. And I thought, if I didn't have a place to save, right? Like in theory, that question makes sense, right? For the person logically saying, if I just saved money in a savings account versus put in this whole life policy, I would have more money. And for the first probably 7 to 10 years, it does make sense, right? Like that math does add up.
Yeah.
But the difference is that also I know what human behavior says is that once somebody gets a certain amount of money in any account that they can access, they will use it, right? Because either they'll use it for expenditures or they'll get nervous and say, oh, it's costing me too much. I'll spend it or invest it, right? And they'll make decisions maybe emotionally, and most financial decisions are not well done whenever they're emotional. And so I totally bought into the concept of having a place that I know it's not earning tons, it's earning 3 or 4% over a long haul. Now that is tax free and all the benefits we get, but
yeah,
by putting money in there, and then I experienced that personally. I started saving like $25,000 a year. That was my first insurance policy I bought on myself. Kind of, you use that 25 grand. I'm like, man, our stories are so stinking similar. And I wouldn't have saved 25 grand. And by the way, the next year when that $25,000 was due, I was like, crap, how thing happened? And so I had to switch it to monthly. But still, I would have never been able to put in that $2,200 a month or whatever the monthly amount ended up being if I wasn't forced to do it. So it forced me to save money. And if left to my own devices, there's no real force for me to put money in a savings account.
True.
So I that's where I would say you mentioned this, and I'm not trying to contradict you. I want to say I agree with you on when I buy a car, if I can buy it at 3.99%, I will do that. Buy it from the bank. I do also buy into the certain people that have heard infinite banking, that they started the insurance policy for the purpose of saving money to finance their cars, right? And while that is not magical in a financial way, it forced them to save money that they otherwise wouldn't have done. Now, once they get there, they're like, okay, Russ, should I borrow the money from the insurance company at 5-6%, whatever, or should I go to the bank at 3.99? I'd say you should go to the bank at 3.99. But knowing that the reason they started the insurance policy because they wanted to be in control of the decision. And that's like, now you got the choice. So for me, it always came down to human behavior was I would spend the money and I wouldn't be forced to save it. Now saving hundreds and hundreds of thousands of dollars every single year into whole life policies, there's no way I would have done that. I wouldn't be saving that money in checking accounts and savings accounts. I would have spent it.
Good point. Yeah.
Yeah. And I'll take it more from my first idea in this came with at the time I'm learning about this, interest rates paid in banks are 0.001%. I mean, ridiculously low return. So it's almost laughable. Like back then you wouldn't even talk about it being a savings account. It's just another checking account. Just call it a savings account, right? So it wasn't too hard to convince me that this has a better rate of return internally over time than a savings account. But then the idea that I could leverage it over time and get two things working at once, with whatever I was going to use for saving, like use that savings for, and the actual savings itself, I was like, well, that's better than one, right? I'm a pretty simple-minded guy, Chris. Like 2 is better than 1 in my mind. And then at the end, it actually has a tax-free death benefit that passes on. There's this kind of built-in estate component that I wouldn't have had otherwise, because up until that point, I think, Russ, you can correct me if I'm wrong, I think I had $2 million of term death benefit when I learned about this. And I'd say this all the time, once I stopped thinking about death benefit, and by the way, if you asked me at that point, I was like dad of the year. I'm like, dude, I got $2 million of death benefit. Like I am something, But when I started thinking about it from what could I do with cash, and I started solving for infinite banking by putting more money into cash value, all of a sudden I had over $3 million of death benefit just like that.
Right.
And now that number is significantly higher. But even out of the gate, I more than solved for my death benefit needs, and it was going to be there forever, not just until a certain point in time where it would, go away. So mine was more, I guess, logical in nature, less about the human behavior problem, but I now see the human behavior things that Nelson led in his book with. So yeah, for sure. That's what led me down there.
Interesting. Yeah. I love that. It reminds me the other day I was driving and traffic was starting to get thick. It's a freeway. We had like 5 lanes, right? And we're going down the freeway. And I was just thinking, okay, I'm stuck. I'm in the lane. I could tell it's slowing down. Everything's slowing down, but I can see the left lane is faster. And so I could have just waited till eventually there's opening, but you know how it is. There's cars behind you and they're going to start speeding up and closing on those gaps. So I slowed down. I braked. Even though I was in the slow lane, I braked even more, got slower, just so I can get to the other lane faster, and then I can go further ahead. So yeah, I let that traffic get a gap between me so I can go ahead. And I kind of see that with the, when it comes to life insurance too, right? When those first few years, there's that net cost, and it's funny how people nickel and dime over that little bit, like you said, regardless of the emotional aspect. They'll say, well, based on my calculations, right? Based on my calculations, this is what I'm seeing here. It's like, yeah, but if I can slow it down to then shift over to this new lane and it's faster overall, and yeah, I'm going to take me a few years to catch up, but eventually, like 5-10 years later, I'm going to have more than if I put it in the bank in the first place anyways, and I can still invest it and I can still do things that you say you can do also with a bank account. Why not? But it's that short-term sightedness I see so many people get locked into, and they just don't see that, when you do invest more than just 5 years, it does make sense.
Yeah. So I would love to talk more about our individual experiences around, what infinite banking did, but then leading into the passive income side. It sounds like, Chris, if I could start with you, you started with the passive income that then introduced you to infinite banking. Did I get that right in your story?
It was about the same time, but
Okay.
they separated it though. They didn't have them as the same. I later learned to combine them together and make them work together versus working independently of each other.
Okay. So talk about like how you learned about passive income then in light of where you're at today.
Yeah, I mean, so I first learned about it, like I said, like right about the time right before I quit being a financial advisor, and I started seeing this new world of alternative investments, right? Things I never even thought possible or was out there because I couldn't sell as a financial advisor, right? I was licensed to sell, not licensed to make people money. I even have a shirt. I didn't wear it for our podcast today. I have a shirt that says like financial advisor, like a definition in dictionary. It says person that paid to sell you crap, not making more money. And that's what I was, right? And so when I learned, and this was the big epiphany for me, because even back then I taught if you're going to retire, you live on 3%, because the 4% rule, we questioned that even 20 years ago. And even today, they've debunked it so many times. But how many people, even the FIRE movement, the financially independent retire early, I got booted out of the Facebook group, even though I did it twice by the time I was 39, which was technically FIRE twice. I got booted out because I told them, hey, if you're trying to do it when you're early, it's a 2% rule, not 4. And they didn't like it. And by the way, don't use mutual funds. They suck, Imagine the real reason they've been out of the group.
Oh man, if you start talking about index funds in that FIRE group, you are just a leper.
I know. I was the weirdo. I actually was FIRE. Go figure. But anyways, I digress. But yeah, like when it came to passive income, that I was teaching 3%. So in my mind, back in like 2003, 4, 5, my whole goal was if I could save up $2 million, I can then live on $5,000 a month or $60,000 a year, 3%. And I thought that was the dream. And so if I'm just cheap enough from my 20s until my 40s, maybe I can actually retire young at that 3%. Because back then, $5,000 a month was more like $10,000, $12,000 a month in today's dollars, right? I wasn't factoring for inflation, obviously. Well, when all of a sudden, like my friend, that was in the real estate space, he's like, well, look, I'll borrow your money. And this is, of course, 2006, 5, 6. They were overly rich in how they were paying in hard money. He was like, I'll pay you 2% a month. And so I did the math. I was like, wait a minute. So if I have $100,000, instead of living on $3,000 a year or 3%, you tell me I can have $2,000 a month with $100,000? Holy cow. And then this whole world, like it was like angels singing, right? This chorus of angels. Cause I'm like, this is incredible. Like I could live on $2,000 a month. That means you only need a couple grand, and I only needed $3,500 a month to be financially independent. I was like, I don't need that much. And by the way, if I sell my house, which has all this equity trapped in it, because I was trying to pay off the house, because I was on that same Dave Ramsey path, like my dad was before Dave Ramsey was Dave Ramsey, right? I was trying to do the same thing. Like sell the house. I actually sold it to an investor at full appraisal, leased it back from him, and then subleased it out to turn into a rental is what I did with that house. And so next thing you know, I was able to strip out my equity, and we called it equity milling back then, stripped it all out, and then I can invest that money. And that's basically when people are like, well, how did you do it? That was how, right? It was like, I was just cashing in all my chips, stripped out the equity, got my money out of prison, as I say today. That's why I tell people don't lock your money up in 401ks and IRAs and stuff, because you just lock away in prison where you can't get to it. So get it out, and then, get it out of prison, get it liquid, and then you can get it out into other investments. So that was the thing for me. It was like, wow, like this is actually possible. There's hope, and that's what got me so excited. And that's what got me telling friends and some neighbors and stuff, like, here's what I'm doing. It's so awesome. You could literally lend your money out to investors and make money. And nowadays it might be like 10, 12% or so you might make, but still, I mean, there's great things you can do, and even today, I mean, like I know you guys and I, we have similar investments we've done. I know I've done stuff with raw land partnerships. It's been awesome. It's been great. And I've done oil and gas. I've done, multifamily. Some of it worked, some of it didn't. I've done single family turnkey homes and stuff. Like I learned now this time around, the second time around, passive was better than trying to be the active investor, like fix and flips and stuff I was trying to do back in 2006. For me, it was better just being the hands-off investor and let other people do the hard work so I don't have to.
And like today, what's your number one go-to for passive income personally, like that lines up with your investor DNA, as we call it?
Today, it's always market dependent, depending on where I'm seeing the trends. The last 3 years, I've been doing a lot more with lending, actually. So more like hard money loans or things like that, where there's some things backing it up, but there's still opportunity. But if you would ask me 5, 6 years ago, 7, 8 years ago, I would have said turnkey rentals, that were, I mean, you'd get cash on cash, like 12, 13, 14% back in those days before interest rates went up, and on top of that, like, I mean, it was just like the rents would increase every year. I mean, I made great money with that with with great leverage too. That's the one thing the market doesn't offer. Even when I was stock trading and teaching people how to trade stocks and options, it wasn't like you could borrow money necessarily to go and invest, right? Like, yeah, you could do some things with brokerage accounts, but not like real estate where I could put a 20% down payment. And then if it appreciates 10%, I actually make a 50% return on my money. I mean, you can't do that in the stock market. You really just don't get that kind of benefit, at least not without risking everything potentially and losing everything in the process.
Right. So Russ, same question. Like, you went from the infinite banking, stacking up a bunch of cash, to then the passive income idea. What was it that clicked for you? And like, what is your kind of go-to passive income idea today?
Well, the thing, Chris, that we talk about on our show is like, I learned this. We coined it, the phrase, before we read it in Garrett's book, this Investor DNA. He loves that, by the way.
He loves taking people's other terms and ideas.
No, I mean, and
We still
he wrote the words Investor DNA long before we ever said them on our show and came up with it.
It's the reverse.
Yes. I think we have created a really cool visual and process that even he gave us credit for. That he's like, man, that's awesome. And he hasn't had a copyright claim on the name against us. So, we're still friends around it. But I was listening to, it's the son
Tom
of the,
Wheelwright, right?
Yeah, Tom Wheelwright, and the son of the Colby founder. I can't remember that son's name, but they were talking about this and on Tom's show, and Tom said something about like whenever he had investor clients come to him and wanted to know if they should do a real estate deal or whatever, he would have them do the Colby and he would give them feedback based upon that. And I thought, man, that's fascinating. We should do that, but for all these different passive income streams.
Mm-hmm.
And we reached out to Colby and they wanted to charge us $50 for every assessment we did. We said, well, what if we bought like 1,000 at a time? And they're like, okay, that would be 1,000 times 50. I mean, they were like not budging on that price point. We're like, it doesn't seem reasonable. So we did some search and ultimately we landed on Disc, and Disc would give us a discount, and they actually allowed us to add our own verbiage into their printout. And as a result, we developed this concept where we take the personality of somebody and the way that we see the world, and we use that to analyze whether or not they would like investing in certain things. We have kind of this pros cons list. And where all that originated from is that the first deal I did was a single family rental property. And I mean, it didn't matter. It was kicking out $90 a month, whether I liked it or not. I hated it. And it wasn't that it was just such a small amount of money. It was that I literally couldn't influence its outcome because it was in a city like 2 hours from me and had a property manager, and I couldn't raise the rents, right? I couldn't pick the tenants, couldn't do anything with it. And I didn't know it then, but the part I disliked about it is that I kind of like to be a hands-on kind of person. I like businesses and investments that I can kind of manage. And Joey and I are currently buying businesses and rolling them up. And like our gifting maybe is how to take an investment and turn it into an operating company and put people in place and install systems through, just our, just experience in business. And I hated it. And we got to a point where we interviewed this guy on short-term rentals, and I was fascinated by it. And Joey and I were just sitting there talking about, well, how can we get this started? And he had had a long-term rental at the time. I was like, well, let's do this. Let's take the next year, kick that person out of there, and let's put it on short-term rental and put it on Airbnb. And the worst case scenario is, like we have to pay your mortgage. I'll pay half of it. You pay half of it. We'll figure it out. And that's what we did. And we started with one and we ended up with over 25. And we just built this business. And we installed an operator, and we could use our influence of one, being able to influence the operator to do a better job, right? Like we could give them training to learn how to do it even better. We could use our platforms to like say, hey, when you're traveling to Birmingham, go stay at Wake Up in Birmingham. And it allowed us to kind of scratch that operating company itch that we really enjoyed, but yet it was a passive income. Like we didn't answer the first call on Airbnb. I didn't take toilet paper to not one single unit or do anything, right? And so it was as passive as any of the other investments I had, other than an hour call a week where we would sit there and look over the financials and give feedback. And man, we were, at the height would probably, netting 25 to 30,000 a month after paying all bills, paying everything. And I thought like, this is the connection. And so for us, it's like connecting that internal thing that we have and what we want to do. And for people who want the opposite of that, well, purely passive, like that's what that investor DNA was meant to do. Is like to say, you're going to hate this about it, or you're going to love this about it. And that's what clicked in my end.
Yeah. And for me, I'll just say that I had that same background that you have, Chris, in the mortgage business. So my initial thought is just lending, right? Like, in fact, right as I left the mortgage business, I had two people within a relatively short amount of time. It was like within the first 6 months or so of having left, they both called me and they're like, hey, I don't really fit a traditional mortgage, but I've heard that you may be interested in lending. And I'm thinking, I don't even know how you got connected to me, but I ended up doing private mortgages at 10%. They weren't even like hard money type deals, but they were for owner occupants with 20% down on 15-year notes. And my biggest failure in that was I made them 15-year notes, and I didn't have like a shorter, turn time that I could like roll it shorter extra years or whatever. Yeah. But that was my initial thought, is like, just do something that which I think was a good first step. Mm-hmm. But from there, it was like, man, we need to do things that will increase that passive income and not tie up the money for as long as I did on those mortgages per se. And so right now, what I would say my favorite thing that we've done is the land business with Mark Podolsky, thelandgeek.com. If people have listened to him, we became friends and learned his model. And we were like, we got to do this. To Russ's point, we got to figure out a way to make this an operating business that we don't run. And at the time, there was nothing. It was like, well, maybe we get our assistant to run it, and we'll do that. She has some extra time on her hands. She wants to build some passive income. We'll work with her, and it was a disaster. It did not yield passive income. It yielded passive payments, for
headaches.
Yeah. And headaches. And active. Yeah. I would say it was less passive. And so we went back to Mark and we said, hey, we got to do this, but we can't do this current model. What can you do? Mm-hmm. And so we hired their team to do it for us. And now that one business yields us almost $35,000 a month. Mm-hmm. And it's all notes. It's all secured by actual dirt. And we have none tenants, no toilets, none of the termite issues that you would deal with in rental properties. So,
Chris, you're involved in that deal, right?
Yeah, I was actually mad at you guys. Well, really, I was mad at Mark because I told him years before you guys did that deal. I said, if you ever have a passive opportunity where I can just hire you to do this, I want to know about it. And he's like, yeah, sure, of course. You know how he talks, like, yeah, everything's possible. Yeah, and then of course I hear you guys are already at a deal, and then several people are already like on a waiting list. I'm like, wait, what? Like, when did you talk to me, man? Like, so yeah, I got involved in one, like it's been almost 4 years now. So, they're my favorites.
Our gifting is influence, man. I'm telling you, like
blaze the trail for you, Chris.
We've seen and talked to so many people who are like, man, I'm in that deal with, Mark Podolsky. That's so awesome. Like, well, you can take me and Joey. You can take us out to dinner anytime you want to, because it took many efforts at like he told us the same thing I think he told you. We just are, like you could like ask our wives. We don't take no for an answer. Like this is just we're gonna keep after him, and we did, and ultimately he caved, and I think we helped him see some vision of what's possible, and hey, you could do this, you could try that. What about this? And we're not going to micromanage you. Like we're going to be completely hands off. And early on, there was very bad reporting, very lack of communication, not a whole lot of, investor, relations, if you will.
You're breaking them in.
But, it's been fantastic. And I've heard and talked to so many people that are doing that with him and having success and have even known people who've sold their business. Like they started the business with him and they needed to exit and they exited and they got twice what they put in. And they're like, man, it's totally worked, And, there's been a number of people who are like, I get a message. It seems like every 2 or 3 months, somebody wanted me to like talk to them about it. I'm like, here's every month we do a podcast and we talk about it. Just go listen to it. I don't need to tell you any more than I tell the public. Well, I know we need to wrap this up.
The thing you guys talk about with investor DNA, that might be something we have to integrate in our community somehow too. Maybe we could joint venture or white label or something with you guys. Cause when we work with our clients one-on-one, that's one of the things we have to discover, right? Because everybody's different. Everybody has a different way of investing. I have some clients that absolutely hate being in the raw land partnership. They're like, I can't stand it, and especially the ones that want like quick wins, right? They want short-term wins. It's like, no, those that want a longer term, they're like, hey, I'm okay. Let's grow this sucker. Let's make it big. But the ones that want short-term wins, it's like, no, that's not what this is, right? And so matching up the right investments for the right people, everybody has their own recipe, their own thing. And so I love that you guys do that because it really, everybody is different. There's no one size fits all. If you ever listen to a show where everybody says you should all do multifamily, or everybody should do self-storage, that's exactly what they're selling you.
Well, we tell people we are definitely investment agnostic.
Yeah.
And if it produces cash flow, we're interested. I know we need a wrap. I'd love maybe like a electric round. What do they say? We don't ever do this, but the
Lightning
round.
Electric.
Lightning.
whatever.
Yeah, exactly. Right. For those non iPhone users. All right. So lightning round. Here's a question that we get asked a lot, but I think we need to answer it for people, and we can do it quickly. Each one of us probably have at least one. Who is wrong for infinite banking, right? Infinite banking doesn't work all the time, right? People ask me like, what's the downfalls or what's the negatives? I'll hear you guys talking about the positives. Obviously, you make all this money selling it. You live fancy lives and all that stuff. And which, by the way, none of that's not true, right? We do make lots of money and we do live fancy lives, but it's because we help lots of people, right? I can show you lots of people who sell life insurance that don't do any of that, and it's because they do it the wrong way. But what is the thing, Chris, that you would say, you tell people, don't do it because of this, or this will go wrong if you try this?
Yeah, beyond what we mentioned about trying to use it as a bill pay account, definitely don't do it for that. Don't put all your income in. But I think in just general, the one thing I tell people is if you're paycheck to paycheck, this is not for you, right? Like if you're literally like you're just barely making ends meet, find ways to free up some cash flow first, get the cash flow under control, then do this. Because I think for it to really do something, you should be able to save. You want to be able to save at least $5,000+ a year to make this at least halfway decent. So that's why I say it. If you can't save at least $5,000 or so a year, don't do it. You can always buy a convertible term policy and convert later on when cash flow is better. Also, if you're over the age of 70, I've noticed that typically, the whole infinite banking type of strategy where you're trying to use it and leverage it, maybe not so much. I would look more from estate planning purpose when you get in your 70s and especially in your 80s. And then of course you're in bad health. But of course, even with bad health, if you have somebody in your family that is in better health, then there might be a way around. You can still make this work. And I've had people do that too. So it's really, definitely paycheck to paycheck. If you're that way, don't do infinite banking. Like it's not going to save you, in the sense that, you're going to make more money just out of nothing. That's not what this is. Like you need to get your cash flow under control.
Yeah.
Joey, what would you add to that?
My add to that is not necessarily physical in nature. It's mindset. If you, now the chances of you being this person and you listening to this podcast are pretty slim. But you know, if you are one of those that's just like terrified of being different or of kind of thinking outside of the box, like you need a very specific box and you can't see outside of that. Like you're like, man, I just need to stick to the herd. This is not for you. It just will never feel right. You will always second guess it. You will always question yourself. And all you need is one of the other herd to say, what are you doing? What, you bought life insurance? Oh, you got scammed. Oh man, the dumb people put money in life insurance. Like, by the way, banks put billions of dollars, so they must be the dumbest of all of us. But, you know, if you can't think for yourself, if you can't get outside of the box, don't do it.
If you thought Anthony Fauci was a good man, don't do it.
Oh man. I only thing I would add to this, I think that, you know, people fall in love with the safety of it, but then never actually utilize it. And I think that that's the downfall that you have, because savers are losers, right?
Yeah.
Like it truly is. Ultimately, if the government is printing money at a pace that it's going to be hard for us to keep up, right? Like it's crazy. This new big, beautiful bill, like the best case scenario is in 10 years, our national debt is only $56 trillion. I don't know if you guys know that, but that's the best case scenario right now. If that goes through as is. So from that perspective, like we can't outsave that. We're not going to earn 3 to 5% and keep up with that. We're going to have to put the money to work. So you're going to need to become an investor. Like this is just going to have to be an element that gets you in the position to become an investor. That's why I love it, is because you have, like you said, I think Chris, you have to have access to cash to become an investor. But you're going to have to learn. You're going to have to take action, and maybe that requires you to invest in yourself and all the other things. But I would say don't do it if you're just going to try to save your way to wins. I think maybe over time you can do that evil thing at the Wall Street, just let it sit there forever and let it outpace the life insurance company. That probably would happen over a long enough period of time. But if you're going to use it, you got to use it or you'll lose it. I think that was something Nelson Nash said too. So, man, Chris, thank you for letting us do this crossover episode. I think that was fun.
Yeah. No, we had a lot of fun. I know my listeners enjoyed this too. I can guarantee it. So I really appreciate you guys having me here.
Absolutely. Thank you for listening. Whether you're on the Money Ripple Show or Wealth Without Wall Street, share this with somebody else. If you're listening to Wealth Without Wall Street, add Money Ripples to your weekly download and definitely get more insights and information from Chris. And thank you for listening. Have an amazing day.
This has been the Wealth Without Wall Street podcast. Don't forget to subscribe to the show to break free of the Wall Street mindset and begin building wealth on your own terms in places you understand so that your wealth will never run dry. See you next episode.